Property is vulnerable. We are a factor of production. We're not just an investment class. Many of you here are involved in the factor of production side of it rather than the investment class side of it, so you don't need me to tell you that. And I guess it's going to take a long time to recover, not just because the pace of business has fallen off, but also because so much of the bank lending problems, of course, are property-oriented. Last year, we put Ian Marcus a little bit on the spot about that, so I'm going to give him the opportunity to speak first this morning and tell you where he thinks at least we've got to in terms of the banking climate and what the implications for property of that might be. Ian.
One of the things that we've all been talking about is in the big bad world we're now experiencing is protectionism. And I think you can actually see this already beginning to happen in the banking community, as many of the banks around Europe have now the government directly or indirectly as a shareholder. They are being encouraged to lend domestically and not overseas. So you're seeing a retrenchment of foreign banks in all jurisdictions leave and go back to their domestic markets. And that capability they have to lend will be in the domestic market. But it is limited. If you ask any chief executive of a bank, what he wants to do at the moment is de-lever. What his government wants him to do is lend. So you have a contradiction between economics and politics, which I think is still to unravel. In the UK, we have a very specific situation that two of our banks provide, to date, well over half of the lending on commercial property. And I think I made some rude remarks a year ago about what was then HBOS and RBS and the significance they have in the market. Little did I know how pertinent those comments may have been. And the health and how they manage their way through this situation is absolutely fundamental to everyone in this room and the future of the property industry because of their dominant position, as I say, of having 55% of the total commercial lending, which the historic figures we have is £270 billion outstanding. I think the new De Montfort figures come out next week or two's time, so we'll get a better feel for it. So very limited debt. The debt that is available is at a higher price, at a much lower loan-to-value, with much more greater constraints upon it. I think we're all beginning to recognise, and it's becoming accepted, that if you have a prime piece of real estate, and let's not get into the specifics of the definition, but good location, good quality building, a long lease, and above all, a good quality covenant, whatever that means in today's market, we're seeing competitive tension now for those properties, and yields actually beginning to harden somewhat. The question that I can't answer myself is, which way are we going to go from here? Will there be a ripple effect that as the demand for real estate broadens, because you're getting nothing for cash, will we see secondary real estate in some shape or form begin to also see the benefits of that flow of capital coming in? Or will the gap between prime and secondary just get wider and wider? That is untested as yet. We'll have to wait and see. What I do worry about, and I think we'll come on to this, I'm sure, during questions, in terms of the capital that's been raised by the listed sector, the capital that's available to come into to real estate more broadly, I do believe we have fundamentally sound companies that are coping with a capital structure because of what they've done historically and because of what the market's done to them that is totally inappropriate and is totally unsustainable. So I'm afraid I don't quite err on the side of we're beginning to see the light at the end of the tunnel. I'm afraid this is going to still be a tough market for a while to come.
I was trying to remember, like Ian, what it was I said 12 months ago. I think one of the messages I was conveying was the speed of correction in the UK markets and how, as we look around the world, from where the UK market was at that time, we felt it offered more potential than any other real estate market that we could see elsewhere in the world. Given the corrections that have continued over the past 12 months, that would still be our view. And from pricing points today, we think the UK market, all else being equal, does, by any historic measure, look good value, look cheap, and offers relatively attractive prospective returns. The sad thing, as an overlay, is to say that we believe that other markets, particularly the equity markets and some of the structured finance markets, CMBS and so on, offers even better value. So do you expect us to be sort of at the forefront of this wall of money re-entering the direct property market? I'm afraid not in the short term. We think we are going to be sort of at the bottom for some while. We don't see the market bouncing back very quickly, with the economic forecast being sort of downgraded almost by the month. We think that the outlook for the next year or two is a pretty bleak one. The speed of decline has moderated, and we think perhaps that corrections that we've seen, sort of yield-driven corrections, may well begin to stabilise by the end of this year, early into next year. But of course, what is now sort of coming up fast in its place is concerns that we have over rental levels, rental values, insolvencies, and the strength of the revenues from our buildings. And I think there are significant corrections in rental values ahead of us this year and next year, and maybe even sort of into the third year. So I think we're at the bottom. We're at the bottom now of quite a wide valley, and I think it will be some while before we actually do begin to see confidence rising on the other side.
Now, I'm going to actually pick up on Liz's theme of the good, the bad, and the ugly, and try and look back over the last couple of years and see what caused this very sharp downturn in commercial property. The first thing, which I think you have to describe as being the bad, is that we did have an over-exuberant investment property pricing bubble. It was bad. A lot of us were involved in it. Doesn't look good. We then walked into a credit crunch, which I'm afraid is the one that I would call ugly. And the only upside from a credit crunch is if you've got a shortage of capital, there is a real prospect of overshooting on the downside and pricing going below fair pricing. And that's what's triggered some of the interest that we have at the moment. And I think just plain sad is the economic recession that's followed on, I think a lot from people being worried that they couldn't renew bank facilities, and they just cut back on capital investment terribly quickly from about 1st October 2008. And you saw it with jobs falling away very, very rapidly. So again, what happens to bank lending, beginning to get statistics about people renewing facilities, starting to do a little bit of new lending, I think will be really important. So what's the good? The good is that property yields a lot when risk-free investments don't yield an awful lot. So people who've been very smart, had a lot in cash over the last couple of years, are now scratching their heads and saying, we're getting almost no return. Where can we get some reasonable income yield with a degree of safety? And of course, that's where UK commercial property, longish leases, upwards only rent review clauses, really begins to come through. And as Ian has said, or Nick has said, we have seen increased buying interest in the very best let properties since the turn of the year. And our experience is that within the last month or so, we've seen a few people looking at mid-quality properties and being very sharp and saying actually hidden within that mid-quality is some quite secure income. But because it's not totally prime, they're getting quite a big yield premium. So we may even have 3 tiers, and this sort of distinction between prime, good with some security of income, and assets which just have no income security whatsoever. Now, knowing who's in the room, I'm going to say just a very few words about development, because I know a lot of you are involved in the construction industry. The very simple issue is there is no point in us developing buildings if occupiers are not prepared to commit to new space. It's as simple as that. The positive thing is that bigger projects take 2 to 3 years to fruition. So we are thinking very, very carefully now, what is the environment going to be like in 2012? What is the environment going to be like in 2013? And on that basis, one can have a little bit more optimism. And I think people will be beginning to dust off plans and think, when is the right time to come forward? Because the one thing about new developments is they're let at the market rent and can then deliver sustained growth thereafter, whereas current investment properties, by definition, will be over-rented and will flatline after a period of time. So I think very, very slowly, in one or two areas, you will get people beginning to think about development, but that will be very, very late cycle. I don't think there will be a rush at all.